Hi, today we're going to learn about the accounting equation. The accounting equation is used to report the assets, what a company owns, the liabilities, the debt of the company, and equity, the net worth of the company. Assets provide the company with future economic benefits and are used in running the company. This can include a building, a vehicle, and money. It can also include monies owed from customers and any expenses that have been paid for in advance. Liabilities are the debt of the company. This can include bank loans, credit cards. It can also include monies owed to vendors, to suppliers, and perhaps you have a customer that has paid in advance and the work is owed to them. Equity. Equity includes the accumulated earnings of the company and can also include shares invested in the company. Assets, liabilities, and equity are compiled and reported on the financial statement known as the balance sheet. And what it does, it gives a snapshot of a company's financial position at a given point in time. So we'll use a very simple example. Let's suppose that there's a business and they have just purchased a vehicle. Let's say the vehicle is worth $50,000 and they've also taken a bank loan of $20,000. So how does that look for our accounting equation? So a vehicle is an asset, and in this case it is worth $50,000. We're also given that the company has a debt of $20,000, so the liabilities are $20,000. So using the accounting equation and some simple math, equity must equal $30,000. So for reporting purposes, on the balance sheet, the company would report total assets, and in this case it would report $50,000. And along with that, they're also going to list each item that makes up the assets. In this case, just the vehicle. And then on the other side of it, we would have total liabilities and equity, which going back to our accounting equation would equal the total assets of $50,000. And again, we would list every item that goes into making up the liabilities and equity. Thus, the balance sheet balances. Let's look at another example. Meet Jenny. She runs a bakery. To get the business started, Jenny borrowed $200,000 from the bank. And she also had investors provide her with $25,000. In exchange, those investors received shares in Jenny's bakery. Jenny used this money to find a location and buy equipment. After her first year of operating, Jenny has earned $10,000 and she owes her suppliers $5,000. Let's see what her financial position is after her first year of operating. Liabilities in this case are the sum of the bank loan of $200,000 plus $5,000 owed to the vendor. This gives us our total liabilities. And equity equals the profits of $10,000 plus the investor shares of $25,000. Thus, total equity equals $35,000. We add up liabilities and equity to give us a value of $240,000. And this will be the value of our total assets. Jenny is happy. With using the accounting equation, Jenny is able to balance her balance sheet. Her financial position reports that the business has $240,000 in assets, and Jenny has liabilities of $205,000, thus leaving the bakery, her business, with a net worth or equity of $35,000. In summary, the accounting equation is used to report the financial position of the business. It reports what the company owns, their assets, what a company owes, their liabilities, and the net worth of the company or equity. I hope you have enjoyed this video. Thank you for watching.